Welcome everyone to 22 Minutes in Lending. I'm your host, Vince Passione, and I'm excited to welcome today's guest, Nick Evans. Nick is president and CEO of Curql Collective, which is a CUSO whose mission is to bring fintech and credit unions together. Prior to leading Curql, Nick was the president of the Viridian Group, a wholly owned CUSO and the holding company of Viridian Credit Union, where he led their equity investments and strategic direction. Fintech investing for credit unions is a hot topic, and Nick brings a very unique perspective, having done this successfully for Viridian and now for the broader credit union community. Nick, welcome to 22 Minutes in Lending. It's great to see you, and thanks for coming on the podcast.
Yeah, thanks for having me, Vince. And it's great to see you again.
Awesome. All right, Nick, so why don't we kind of start off with structure to start with. It is kind of unique. You've got these two CUSOs. You've got Curql Fund 1, and then you've got the Curql Collective. And these two CUSOs come together so that they can serve these three constituencies. You've got your investors, you've got the fintechs, and you've got the credit unions. So can you talk a little about the structure? It is unique, and how it benefits your constituents.
Yeah, but before I do that, Vince, before I talk about the structure, I do have to say there is a third company. We just opened up Curql Fund 2. So there's Curql Collective, Curql Fund 1, and Curql Fund 2. And that's an important announcement for the industry. It's something that I would be remiss if I didn't highlight that here before I talk about and before I answer your question. So Curql Fund 2 is open. We believe it'll be bigger than Curql Fund 1. We believe we'll have more investors. We left a lot of credit unions standing at the door when we closed Curql Fund 1. So, hey, to all you credit unions out there, we're ready to talk to you about Curql Fund 2. We believe we'll be able to write bigger checks since it's a bigger fund out of Curql Fund 2. And we'll talk more about that later, Vince, in another question that you have. But I would be remiss if I said, hey, we are ready to talk to everybody about Curql Fund 2.
And size of the fund, you have a sense of how
Well,
size the fund?
we believe it'll be anywhere from 300 to 500 million in size. It will close next August. So we have plenty of time. You know, there's like liquidity headwinds in the market. We're giving CFOs and CEOs plenty of time to forecast, to plan, to understand how we're going to do cash calls in Curql Fund 2 differently than Curql Fund 1. And so it'll be capped at 500 million, and the board is adamant we are not going over that. And August 31st, 2024, whichever comes first. So if we got to 500 million in commitments in May, we will close. So to my message to credit unions is don't wait, get the legal documents in hand, have the conversations you need to have with your board, strategically plan around what you need to do here, and off we go. Now to answer your questions about structure. So when we were developing the concept around Curql 4 years ago, the fund was the center piece or the focal piece, right? Everybody has had this idea, not everybody, many of us have had an idea for many years that there needed to be an investment fund inside of credit unions, putting capital to work from credit unions and fintechs that needed them in order to have a bigger say in those fintechs and the roadmap as they grew and as they built their product on the backs of credit unions. And so the fund, the investment fund was the initial concept. Well, what happened, Vince, was as we were developing all of the concepts around, hey, let's do an investment fund, we looked at it and we said, well, there's really 4 pillars here that we need to focus on. And the first pillar was the credit union fintech collaboration piece. And that's the biggest part of this. The second pillar was ready money, a fund. The third was the fact that we wanted to create strategic alliances across the entire industry. And the fourth was regulatory modernization, of which you're going to be a beneficiary of this coming Thursday when the NCUA passes a new regulatory rule around fintechs that originate loans and credit unions that want to buy those. So, we were a big part of this modernization, but the 4 pillars, and so, ready money or a fund was really only one of the pillars, one of the 4 pillars. So what we said is, okay, we're going to start a fund, but we really need a company that sits over the top, more of a governance type that tracks these 4 pillars and really focuses on the mission. So the fund does one thing, and that's Curql Fund 1, and that's one company. And now we have Curql Fund 2, that's another company. And Curql Collective became the focal point around how do we keep it all together. So what we do at Curql Collective is it's really simple. We have this mantra around the three legs of the stool. And so the Curql Collective's role is leg one is fintech, leg two is credit unions, and leg three is the fund. So the fund, fintechs, and credit unions, three legs of the stool. And where the three legs of the stool meet at the base of that stool, that's where Curql Collective resides. We reside at the intersection of the three legs. And so our job is basically to keep fintechs in front of credit unions and credit unions in front of fintechs.
So, Nick, just structurally, though, I want to step you back for a second. Credit unions could not invest directly in fintechs. Is that a true statement? Because I know Viridian in the past, in your prior life, you made some investments, but is it a CUSO can invest in a fintech, but a credit union can't, and that's why the fund is actually a CUSO? Do I have that right, or am I misunderstanding it?
So here's a clarification. If a fintech takes $1 from a credit union or a CUSO, it is a CUSO. It becomes a CUSO. So the answer is credit unions can only invest in CUSOs. CUSOs can only invest in CUSOs. So everything that we invest in today out of Curql Fund 1 has to be a CUSO. So when you say they can't, we can invest in the fintech as long as it's a CUSO. And credit unions, when I was at Viridian, we did several, but those all had to become CUSOs. Now there is a misconception out there. So when I was at Viridian, we invested in Alchemy, and Alchemy is now a publicly traded company. And so the perception is, well, credit unions can't own parts of a publicly traded company. Well, they can, as long as that publicly traded company remains a CUSO. And so there's some nuances within all the rules, but it basically boils down to the fintechs have to be a CUSO. They have to declare and be a CUSO, and it's that just means they have to 51% primarily serve credit unions or credit union members. That's the biggest stipulation. So, and we don't have a problem with that conversation when we're investing. We've done 22 investments to date in Curql Fund 1, and all 22 of those companies are CUSOs today. And so, and I would say 80% of them were not CUSOs when they started having conversations with us, and thus had to become CUSOs.
And the CUSO structure clearly didn't interfere in the case of Alchemy to become a public company.
Right. A CUSO, once a company is a CUSO, they can still go public and they can still seek venture capital money. You know, we're invested alongside many, many venture capital firms across the United States. We're in deals with Andreessen Horowitz and the likes of, the most famous VCs on the planet. And so that doesn't, actually the VCs have a bigger conversation with fintechs. When a fintech comes to them and says, I'm a CUSO, the VCs have a bigger issue with what the heck is a CUSO. So the education takes a little longer. The education takes a little longer in that case. So, but that's the governance structure. So Curql Collective, if you think of it as the umbrella that sits over the rest of everything else that goes on underneath the umbrella. We like to say we're the governance CUSO from that standpoint. So we hire the fund manager, we seat the investment committee. Curql Collective is governed by a board of our investors, and so basically we've set the whole structure up under Curql Collective.
And technically, if I look at the fund, does Curql Collective show up as a general partner?
Lead general partner. We are the lead general partner. And so,
So going back to my question then, Nick, if you think about how you serve those three legs of the stool, right? Why does that structure, it's an atypical structure, right? How does it benefit all the three constituencies? I think I understand it, but it'd be good to explain to our listeners that structure is very unique in the industry, and you pursued it for a very specific reason. Can you
Right.
explain why?
Sure. So take leg one, which is credit unions. And so we're serving credit unions every single day by bringing transformative technology to them. That's how we're serving credit unions. We're serving fintechs by bringing 68 very, very astute, mostly large credit unions to the table. We're a strategic investor. We do not use the word venture capital. We are strategic. Our funnel right now, Vince, runneth over because of the fact that we can bring 68 potential customers to the table for those fintech. We serve the fund in the capacity that we help educate the fund on how credit unions work and how credit unions engage and interact with these fintechs, or how they should. The fund manager is Next Level Ventures from Des Moines, Iowa. They don't necessarily know how credit unions work every single day, how they operate, how they have to deal with certain regulatory and compliance issues. And so what we do is we help bring that education piece to the fund manager so that when they're looking at a fintech to possibly invest in it and they're doing their due diligence, we're making sure they're asking the right questions. So that's how we interact with those three different legs of the stool.
That makes sense. I sort of cheated a bit, and I've been introduced to the folks at Members Development Corps, Jeff and his team, and the question comes up, what is Members Development Corps? And Jeff will describe it as they're an R&D arm. They're a CUSO. They do R&D. They have, I think, 70 of the largest credit unions in the country who come together and really think about strategically what does the credit union system need? What types of technology solutions they need? So, what is the relationship between Members Development Corps, Jeff and his team, and then the Curql Collective?
Yeah, great question. And we make no bones about it. We were born out of MDC. Curql and the whole concept was born at MDC as part of a project. And so they're an R&D QSO, 80 credit unions, and this was a project. So is there a need? Is the time right? What kind of things do we need to pull off in order to, um, to create an investment fund inside the credit union industry? When I was at Viridian Credit Union, we joined MDC, and Jeff knew of my experience around investing, and so he nabbed me right away and said, "Hey, we want you to be on this project team." And so it was Martin Walker from Sound Credit Union and Ben Maxim from Michigan State and Jeff, and I'm missing some people, but there were some other really astute people on this project team, and it just kept rolling. And I always liken it to the snowball rolling downhill. And finally, Jeff went to his board and said, "Hey, we have something here. This is something that we can launch out into the industry." And kudos to MDC and to the board and to their members. They said, "Yes, this is a go. Let's go for it." And so then that project team basically became the board of Curql. It wasn't even called Curql then. We created a company, we created a board, and we said, "Okay, what do we do here?" So that's how the seeds were planted. We did an RFP for a fund manager in the summer of 20, hired the fund manager in August of 20, and we started raising money, and the rest is history. So did our first investment in April of 21. But that was also the time when, once we launched the fund, Vince, we said, "Hey, there's there's a need for a bigger part here in an ecosystem, not just the fund." And that's when we went back to our four pillars. And that's when we said, "Hey, I think we're going to need," the project team said, "Hey, I think we're going to need to create this governance company over the top of everything we're doing here." And that's when Curql Collective came about. And I was hired in June of 21 to lead Curql Collective.
So, Nick, let's step back to the pillars again because you raised them, and we had board member Hood on in one of our prior episodes, and he is also very atypical, not what you expect as someone as who's a prudential regulator. He's very forward thinking. He's very, very predisposed to fintech and why fintech needs to be part of credit unions and credit unions need to be part of fintech. But you talk about regulatory modernization. What does a fund or a fund manager have to do, and how do you influence regulatory modernization? I would think that the prudential regulator would be pushing you away. You represent risk. You're an investor.
Well, on the surface, it might look that way. But you mentioned board member Hood. Board member Hood has been a huge friend to what we're doing, only because he was leading the charge initially. He was the one out there, out front, saying, "Credit unions, you have to find a way to collaborate with fintech. And fintech, you have to find a way to collaborate with credit unions. Otherwise, we're going to be left in the dust. We're not going to keep up with the big fintechs that are disintermediating us. We're not going to keep up with the big banks." So kudos to board member Hood. He has always been banging this drum from the get-go, and we've kind of run with it. And so, we say we're de-risking this. We're not adding risk to the system. In fact, the NCUA is on record as saying you do not pose any risk to the NCUIF fund. We're de-risking. In other words, we're saying, I say out loud to credit unions, you should not be investing one-offs, one-on-one. You should be using us to be your eyes and ears and letting us do the due diligence and letting us ask all the questions and do the tough negotiating. What's gotten really interesting, Vince, over the last couple of years is people like you. You are a very sophisticated entrepreneur, a very sophisticated CEO. You've been there, done this, right? We have fintechs entering the space where the CEO has exited 3, 4, 5 companies, all venture backed. They know how to talk this game. They know how to raise money. They know how to talk about their valuation and make it sound logical. And so, to their credit, they're very smart people. And so our credit unions today aren't that sophisticated when it comes to talking to people that have been there, done that. And so what we're saying is we're hiring professionals to manage our money. They know how to negotiate. They know how to talk about valuation. They know how to place a valuation, determine the valuation. If the entrepreneur is a little elevated in their thinking, we're not afraid to tell them so. And so we're saying that we're de-risking that part of the conversation for the credit unions that are in our fund because they just don't have the bandwidth nor the money to hire somebody with this kind of expertise. So we say, let us do it for you.
No, look, it makes sense, right? I mean, this is a profession. Venture investing is a profession. It's not a hobby. And you talk about risk, and I'm going to use a pun, but I want to. I question. How do you circle the square, right, on risk? Because you touched on it, and it's not for the faint of heart, right? I'm an angel investor, and I probably made over a dozen investments that I sort of manage in my portfolio, and some of them are great, and they pay for the ones that aren't so great. How do you deal with that risk when you deal with a credit that says, I want to put money into the fund, and now you're spreading it out over, 20, 30 companies. And I understand you're multi-stage. So it's seed, it's series A, you're going to do you're going to stay alongside these companies. And there's some risk associated with that early stage part of the investing cycle. So how do you circle the square on risk, and how do these credit unions look at their members and say, this is a good use of our capital, and you should feel comfortable with me, CEO of this credit union, taking this risk?
Yeah, let me answer that 2 ways, Vince. So first, I liken it to a mutual fund. So we're in 22 fintechs right now. 22. Which is more risky, being in 22 fintechs and only 1% of that big broad spectrum, or owning 2 fintechs and owning 10% in one and 15% in another? That's a lot of risk right there. So we're spreading that risk. We're diversifying risk. We're a mutual fund. The other thing, and you touched on it very nicely, when we first started raising money for Curql Fund 1, we said we're going to be an early stage investor. We're going to focus on late seed, early A rounds. Well, what we've done is just almost by accident, we're not doing it. We're stage agnostic at this point. We did some analysis on the 22 companies, and we've done a convertible note, clear through an FRA. And what I'm saying is that by being open-minded and really looking for the best technology, it's actually forced us out of that early stage investing mentality. And now we're saying, well, since we're stage agnostic, we wouldn't even be in some of the companies if we didn't invest in an FRA. We wouldn't be in Zest AI if we didn't do an FRA. We wouldn't be in XYZ FinTech if we didn't consider their convertible note. And also what that does, though, that diversifies within our portfolio. So not just 22, but diversity of maturity inside the portfolio. So we have some young entrepreneurs, some first timers, but we have some 2 and 3 and 4 times successful entrepreneurs on the other end of the spectrum. So we're seeing diversity in 2 ways from that perspective. And to me, that's helped. Again, when we talk about de-risking this, that's actually helped this entire conversation. So we don't eliminate a conversation just because they say, well, we're in a C round, and we say, we're only doing A. The other thing is we thought we would write $5 million checks. We've written some smaller checks. We just did our largest investment, our largest 1 check investment last Friday. And that was only 7.5 million. So you can see in between, we've put $118 million to work already. And, those are pretty small checks for that much money. We still think we're only going to have about 30 fintech in the portfolio when we're done with Curql Fund 1. We think Curql Fund 2 is going to be a little bigger, Vince, money wise and number of companies. So we're looking at how we manage that as well. You can't be on 70 boards, right? Just a handful of people can't be on 70 boards. So we're looking for ways. And that's another thing we do. We make sure that we try to grab board seats when we can. Again, that gives our credit union say in where the product is headed on the tech roadmap and things like that. So we're doing a lot of things inside of the investment piece that are de-risking this.
So you touched on it. I just want to stay there for a minute. So board governance. It's interesting, right? As a strategic investor, if you're sitting alongside of other investors, and your interest is that credit unions get some structure or credit unions get some feature or function, right? So that they have a say. But what happens when the other investors who potentially aren't strategic investors, they're just money managers? How do you solve that problem? And do you find yourself, it might be too early, having to recuse yourself from certain conversations because of that strategic bent that your potential interests might not be aligned with the other board members? Or I have that totally wrong?
Well, I contend we have a stronger voice in the boardroom because we are strategic. And so a lot of times, if we're sitting alongside of two or three VCs, a VC invests for one thing, Vince, right? They want a return. They say, here's our money. Call us in 3 years when you're ready to exit and tell us how much we're getting back. And so when they sit in the boardroom, they're very helpful. Don't get me wrong. But when the CEO is sitting there saying, hey guys, their voice has 68 people behind them, 68 potential customers, all large behind them. When they talk, we're going to listen. So the strategic factor, I think, weighs out in the boardroom more than just a traditional person that's just waiting for a check, if you know what I mean. And so I think that the CEO in this case carries the water in those conversations by taming down that conversation with the others and saying, hey, these guys, we have to be in credit unions because we agreed to be a CUSO. Therefore, we're going to listen to this strategic investor who has 68 credit unions with them.
Makes sense. Good answer, Nick. I appreciate that. So Nick, let's go back to the actual investments. So you said it's over 20 investments, over $100 million invested, and you've spoken about these swim lanes I've heard in some of the interviews while I was kind of doing some research for this podcast. Can you talk a little about the swim lanes and sort of the focus you've got?
Sure. So we've identified about 15 to 20 key, what do I say, categories is not the right word, but key areas that we want to own a piece of. And so it's no secret that early on when we started Curql, lending was a key swim lane, right? So we invested in 3 lending platforms because lending was so hot at the time. That's changed in the last 3 years. It's changed drastically. But the things that we identified, lending, so auto lending, mortgage lending, refi lending, all kinds of things, home improvement lending, HELOCs. Those are the kinds of things we've identified within lending. But the other things like cybersecurity, fraud, marketing, you get the idea. We want to be in all of those segments or all those sections of what's important to credit unions. And so we have a swim lane map, so to speak. And so we're mapping, if we were to invest in you tomorrow, we would put you in our swim lane map where we thought you fit. And we don't like to duplicate, at least right now, we don't like to duplicate and invest in like companies. So we had this conversation really early on. One of our early fintechs raised a stake when we invested in another fintech that they thought was a competitor. And we said, wait a second. We've done the analysis. Now we agree, we will not invest in a company, in a fintech that does 100% of exactly what you do. But in this case, we believe they only do 10% you do. So you're going to have to get over it because there's still a 90% there of the market that we are trusting that they're going to hit this other company. So those are the kind of conversations we have around our swim lanes. So we still have some gaps in our swim lane map for Curql Fund 1. As companies exit, like Payrails did last September to Jack Henry, then we can backfill. We could look for a new payments company, and we did that. We invested in neural payments after Payrails was sold. So those are the kinds of moving parts that we see inside of our swim lane document. But that's what we call swim lanes. Those are segments within the tech stack of a credit union.
So you raised Payrails, so let's go there. Very interesting. I took note of that because it was probably a record investment both in time and in outcome. So a little over $5 million, right? I know Canopy Ventures involved. My friend Chip Mahan, he was also on a previous episode. He did it back in 2021, and then pretty much about 12 months later, you sold it to Jack Henry for a nice multiple, right? And uh, I guess it's sort of in my thought when I look at the way you're investing, I'm sort of thinking you want control, right? You said you want to be in the boardroom, you want to be able to represent your credit unions and make certain that their money, has bearing on the strategic direction of these companies. How do you once again, using a bad term, how do you circle the square on on that company IPOing, which was great from an investing perspective, but now suddenly it's now owned by a core processor. And look, I think the world of Jack Henry, but they're a big company, and some of my clients don't feel like Jack Henry sometimes is responsive as they want. So did you just lose control there?
Absolutely not. So first of all, the conversation on why they wanted to buy Payrails was first and foremost. That was key. Why do you want to buy this company? The answer was, we think they have a better payment solution than what we're currently offering our clients. And we're going to supplant our current system with this new technology after we acquire it. So that was a key part of the conversation, right? So if they would have said, well, we're going to totally dismantle the company and the technology, we're just buying it to get it out of the way, we wouldn't have gone for that ever, a million years. And we're going to really be, ultimately at the end of the day, it was owners, the primary owners of Payrails, it was still held by, Fred and a few other people. It's ultimately their decision, but we're going to have impact in that conversation, and they're going to listen to us around, we aren't going to sell to somebody that's going to dismantle it just to get it out of the way. So we have fear of that with some of the bigger players in our industry, and we know who they are, and they're notorious buyers. But we're going to pay attention to that. The other thing is, Vince, they left 2 or 3 credit union people in place on an advisory board to help with, be a sounding board for Jack Henry in the credit union space. Now, Jack Henry's a big player in the credit union space, no bones about it. And I know some of the people, they're great people, they're nice people. They have a presence in Cedar Falls, Iowa, where I live, and I know some of the folks. So that was a little less of a worry, so to speak, especially when they left some of the people on the advisory board, of which a couple of them are on the Curql Collective board of directors. So that also helped. So you get the idea. We were paying attention to what they were going to do with the company, what they said they were going to do with the company, and the fact that they still wanted to hear from credit unions regarding the direction of the payment solution once it was inside of Jack Henry made a lot of impact with us.
No, that makes a lot of sense, and I'm glad you explained that to me because it does make sense from an impact investing perspective, and that now you've got this new contender, right? That's absorbed by a company that can take it to the next level. It makes
Yeah.
sense.
But there's no question. If somebody said we're going to buy it and we're going to abandon credit unions altogether, we won't go for that. We will fight tooth and nail. Whether we can impact that or not, we'd have to see how much of the company we own. But we will we will stand up to as many people as we need to try to prevent it.
So, Nick, we were chatting before we went live, and I was reviewing the conversation I had with Matt Harris at Bain, and Matt made an interesting observation. He said it took 18 years for fintechs to recover from 2000, and now we have 2021, which was a really rough year. And Matt's prediction, and he's gone public with this many times in different forums, is it's going to take 40 quarters. I'm not sure how he gets to 40 quarters, but it's going to take 40 quarters for these fintechs to recover. My counterpoint to that is a lot of those rounds, or in the old days, would have been IPOs, and judging it that way is probably not the best. But A, I want to hear your thoughts on that. And then B, you've been quoted a few times, right, in an interview that I was watching and researching this episode, where you said, look, there's 15,000 fintechs, and I think there's 10,000 too many. And the industry is at that cycle where, there's going to be some consolidation. So give me your sense of where fintechs are in their evolution, valuation, M&A, what's next? And then how do you manage around that when you look at your investors, the credit unions?
Yeah, great question. And Matt's a great guy. I have a lot of respect for him, and I'm sure he has some really sound research on, why he's saying what he is. And I do have to give Brian Koss from True States Ventures credit on that quote. I heard it I was with him at lunch at GAC, and he's the one that said, there's 15,000 fintechs in the US, and that's probably about 10,000 too many. Here's how we're going to have an impact in this conversation. So Curql Fund 2, we just launched 2 weeks ago. We are now raising capital for Curql Fund 2. We will be done investing out of Curql Fund 1, we think, in the first quarter of 2024. So we're raising money. We think Curql Fund 2 will be bigger than Curql Fund 1, and Curql Fund 1 is 252 million. So you get an idea. We're estimating, even with the headwinds in the market around liquidity and things like that, we think we're going to have a fund anywhere from 300 to 500 million. So we're getting a lot of questions, and our board was very cognizant of this when we started talking about Curql Fund 2. How are we going to deploy that much money in light of what you're saying about recovery, about IPOs, about all the factors that we see going on in the market? And so here's what we're going to do. We're going to write bigger checks under Curql Fund 2. And you might be saying, well, for what? We think that there's going to be consolidation. We think we can help with it. So when a company comes to us and says, hey, I want to go buy XYZ company because A, can help make my company bigger. It can make my company stronger. It can make my company more appealing to the credit union industry, because now instead of one product or two products, I have 3 or 4 products. And so we call it the platform play. There's going to be a lot of platform company creation going on, and we want to be a part of it. And so, and we have been to some degree. So as an example, Eltropy came to us several months back, says, I want to go buy Papillon and Marsview, but I need capital to do it. So we partnered with one of their VC partners, and we combined our money and we invested again in Eltropy. And they went out and bought those 2 companies. Well, with Curql Fund 2, because we have more capital, we will have more capital put to work. We think those conversations will be more prevalent, and we're going to be able to write $10 million and $15 million checks when a company comes to us and says, hey, I can go acquire this company over here and make everything bigger, better, and more appealing to the industry if I can pull it off. And so we're going to participate in those conversations.
Now that makes an awful lot of sense, and congrats and good luck on Fund 2. That is really amazing, and that's a wonderful testimony to how you managed through Fund 1. So congrats there.
Yeah, thank you, Vince.
Nick, I'm going to leave it there with it. Thanks so much for sharing the insights, and thanks to our listeners. It's been a great 22 minutes, Nick. So I want to thank everybody for tuning in. Don't forget to subscribe so you can enjoy future episodes, and I'll meet you back here in our next 22 minutes in lending. Thanks again, Nick.
Thank you. Take care.